Hey everybody, this is Dan Rawich. I wanted to just do this video. It's going to be a little bit long and hopefully not boring. I'm going to try my best to just kind of go over the real key elements of what happened last week. And I'm taking the time to do this on a Saturday morning because I'm worried about you guys. So much panic, so much concern. Maybe not even a panic, you know, in many eyes of loan officers, but I know that your borrowers are confused, as they should be. I know you're probably confused. This is an unprecedented time. So here's 20 slides. I'll go through them as fast as I can. I want you to feel free to share this with your buyers and your borrowers so that they sort of know what's happening. You know, the end of the story is this too shall pass, and probably sooner than most people realize. So here we go. So people bailed out of stocks, they bailed out of bonds, and they bailed out of gold. That's the bottom line. And you can see the rise in money market assets rose to levels far greater than what happened in the 09 crash. That just means everybody got out of everything and went into cash. That's what happens when things get really fearful. Typically, well, I'll show you that in another slide. We'll wait for that. So this is what the market volatility looked like. And this is actually bond market volatility. There's an index called the MOVE index. We'll get a better look at that in a minute. And what you can see is the volatility in the bond market rivaled that of what happened in 2008. And in fact, yeah, that's right. So, and this is the government securities liquidity index. Again, worse than we've seen it, more illiquid in that market than we've seen since the Great Recession. Okay, so normally when stocks fall, bond yields fall too. I'm not talking about bond prices, I'm talking about the yield, the interest rate. So they're supposed to fall together. And this is what happened beginning on March, actually overnight markets, March 10th. Yields started skyrocketing and stock prices fell. Now the good news is toward the second half of the day, the stock futures got better and yields came down. So we saw a little bit of a correction here, which was good, but they still moved opposite, which is not normal. But the good news is we saw yields come back a little bit, and I'll show you why in a minute. This is the spread, the bid-ask spread from US Treasuries. Now, I've talked about this before. What does this mean? This means that anytime you buy or sell stocks or bonds or anything, there's a bid and there's an ask. And that spread in a liquid market is super narrow. So bid would be, ask would be like, I'm going to sell my car on Craigslist. I'm going to put it there for $20,000. That's my ask price. No one's going to call you up and say, hey, I saw your ask price. I'm going to hit that price and here you go. Here's your 20 grand, unless you had some rare car underpriced. They're going to bid you something and they're going to bid you less than the ask. Same thing. If I want to sell my stock or sell my bonds, I want to ask a higher price, but there's always going to be a bid out there waiting, a hungry bid, like give it to me. And the wider, the more things get volatile and the more illiquid they get, this hungry bid just gets lower and lower and lower. But the desperate sellers are still up here asking for more. And then finally they get desperate and they just feed the bid monster. So the wider that gets, the more illiquid the market gets. We don't trade in our options group. We don't trade anything unless the bid-ask spread is very narrow, because that equals liquidity. So this is the liquidity S&P futures. It's fallen to a near record low. This is, to me, unbelievable. I haven't seen, you know, a drop like this fast ever. Volatility. So I talked about the MOVE index. So a lot of you probably know what the VIX is. The VIX is it's considered the volatility index. It is something that we invested heavily in our options group toward the end of last year because we saw this coming. The VIX went from, I think our group bought it around $12. I think it hit 60-something dollars just in like almost 2 weeks. So the moral there is, by the way, not trying to impress anybody, you can make so much money in this environment if you stay on the right side of it. But the MOVE index, again, look at the volatility. That's the blue line. It's somewhat hidden here by the red line, but volatility in bonds hadn't been that high since, again, 09. Volatility in stocks, the red line, again, hadn't been that high since 08. Very freaky period. Most of it went down Wednesday, Thursday, Friday. And this is just kind of a quote from a couple smart people. One, Zoltan Pozar, he expects the Fed to effectively launch every liquidity bailout operation possible, except maybe purchasing stocks outright. And I don't know if that's off the table. Remember TARP? The Fed just cutting rates again at this stage is really not the right medicine. The Treasury market is broken. With it being very illiquid, there's very wide spreads between on and off the run spreads and other signs of dislocation. This is interesting. Let's hope Powell, who first diagnosed the real problem with the US capital markets back in 2012, he wasn't even the Fed yet. So this guy knows how to fix this. I believe that he will. Okay, the next three slides are pretty important because these kind of have to do with what's going to happen with the stock market. And what's going to happen with the stock market ultimately is going to be the reason that interest rates go back down. So this was all on Friday. The Fed announced their $1 trillion liquidity plan. And after that happened, these are stock prices here. Stocks ran up. Right after that, fear jumped in and stocks bailed down hard. They fought their way back, and then Trump came in and talked about his stimulus plan. Stocks rallied and they closed on their high. That all seems good. That would make you think, wow, we're in good shape. Monday should be good. This is going back to 2009 when TARP was announced, and you can see the same thing happen. When I think it was Hank, I forgot his name, Hank Paulson. He was the Treasury, the Treasury Secretary. He announced TARP, stock market rocketed. But watch what happened the next day. The S&P then fell 35% after the initial TARP bounce. This was the TARP bounce, and then this was the fall. You got kind of suckered back in, which is what markets will do to you, and then it fell really hard. You kind of got to believe that's what's coming. We got this great run on Friday. I don't think it's sustainable, not with the underlying dislocation in the markets. This was really, really troubling to me. This is the New York Stock Exchange Composite Index. It's the performance of about 1,900 stocks. It fell to levels below the high of 2007. Think about that. 13 years ago, that's the level that we touched. This is the VIX. The VIX is the fear index. And again, this is what happened in 08 and 09. And this is what happened basically Friday. I mean, it keeps going. It almost $80. It just kept going up and up and up. I don't think you should feel safe in the stock market until the VIX index is back down below 25. You could watch that. Just type in any Yahoo Finance, type in VIX, and you can see what's happening. So again, this is what happened. So Treasury yields and the NASDAQ are supposed to move together. The last one was the S&P. And then this is what happened on the 11th. They just completely dislocated from one another. Not healthy. This is what happened to the U.S. Treasury yield. This is probably good news as well. This is what more or less happened in the overnight markets. The Treasury yield jumped from 1.45 to 1.80, the highest single move in the Treasury yield in the history of the U.S. Treasuries. It then kind of worked its way down and sort of normalized. And then Trump spoke, talked about some of the stimulus plan. The Fed talked about their bailout plan. And you can see yields plummeted back down close to where they were before things really got ugly. And then as the course of the day, it just went up a little bit. So this right here is a really good sign. This is telling us that things will calm down. The market will respond to the Fed. The Fed has to take massive action. I think we did this one already. Oh, this is actually the spread between the high of the day and the low of the day. It's the highest spread's ever been in the history. I'm going back to 1980. We've never seen a spread between the high and the low of a day in the 30-year weekly bonds. This is the TLT. You hear me talk about that a lot. This is a treasury, a fund that buys treasuries. We traded a lot in our group, and oh my gosh, this is really about liquidity. This is what happened. It just crazy. Okay, I think you'll like this. So the market, the futures market, and other vehicles will help us kind of predict what the Fed's going to do, because the market will move ahead of the Fed. And this is telling us that the market is expecting a 100 basis point cut in the Fed funds rate, 100 basis points. Think about that. Fed funds rate are currently a half. So we're going to go beyond 0%, and we're probably going to be, negative 0.5%. This is suggesting as low as a negative 0.93. I don't know if we'll get there, but it's very possible. Gold also got crushed. Again, this is just going to this massive amount of fear. Gold has always been a safe haven. Gold you can count on. Let's see, when does this thing go back? 2000. So you can see what happened to gold prior to the financial meltdown. And you can see what happened to gold kind of as all these problems were beginning to happen. But gold plummeting like this makes no sense at all. That is not going to last either. I think gold's going to be a real good investment next week. Okay, here's the bad news. People ask me where do I think the S&P is going. I think it's going to 1800. I don't think we're going to get down here. And the reason I think that is this is taking in the corporate profits and where they're headed. So corporate profits were climbing on their way up, and the S&P got way ahead of the corporate profit. You can see corporate profits and S&P sort of moved together. They dislocated here in 1999, 2000. That was a crash we had. And you can see when that crash happened, the S&P crashed down to the corporate profit number. They follow each other, guys. This is where I got really bearish at the end of the year. I say, this doesn't make any sense. How can the S&P be so far ahead of corporate profits? So if the S&P falls back down to its historic level, that's why we get to 1800. Because a lot of people are like, you're crazy. How can I get down there? Well, this is how I can get down here. Math is starting to matter again. This crazy FOMO, insane buying that I've been screaming about for months and writing about every single week, it's manifesting itself. All right, so in closing, my best guess as to what comes next. The Fed will jump in more aggressively than we've ever seen before. Things will get a little bit worse before they get better. Might even get a lot worse before they get better. In the next 1 to 3 weeks, the Fed measures should take hold in the bond market. Rates will likely fall to 0 and possibly down as low as negative 1%. And MBS rates, mortgage-backed securities, are going to be too good to resist. How are you not going to invest in mortgage-backed securities when you have a positive yield as opposed to having a negative yield as an investor? Now that assumes that the liquidity problem gets solved by the Fed, and I think it will. The S&P goes to at least 1800. Here's the important part. Home buyers, if your mortgage loan officer sent you this, take heed. Please, 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 please. I'm going to get this right. Remember, Warren Buffett said when people get greedy, you should be fearful. There's been a lot of greed in the home buying market. Seller greed, buyer FOMO, fear of missing out. It drove home prices up. I don't think there was a bubble ever created in home prices. I don't think we're nearly at a bubble. But greed is a time to be fearful. I wouldn't have been buying in this home market, not just yet, unless I could get a payment less than rent. That's what it's all about. But so fearful homeowners will pull back, and the brilliant homeowners will jump in without the competition they fought against for the 2 years. How would you like to make an offer and have it accepted? How would you like to make an offer a few percent lower than asked and get it accepted? It's going to be a wonderful feeling. You home buyers, what you've gone through is not normal. It's not normal in history. So again, whether in homes, stocks, or bonds, when people are greedy, be fearful. And when people are fearful, be greedy. People are fearful. This is your time. This is your time to get in probably with the record low rates without the home buying competition. That's my thought. All right, guys, I hope this was helpful. Any comments you have, put it in Facebook. And, love to hear from you. Take care. Bye.